Okay, welcome back everybody. So in this video lecture, we'll be doing some more advanced economic modeling, incorporating the foreign sector into our work and building upon the simple modeling techniques that we developed in the previous lecture on introducing economic modeling or introduction to economic modeling. I'll put a link to that video in the description below. So you can check that out if this looks perhaps too daunting. But otherwise, let's hop into this. Okay, so here we have starting with some of our economic relationships that we wish to understand. You'll recognize the consumption function, the first equation, second equation there from that previous lecture where we said that we were going to hypothesize that people's consumption sort of story goes like this, that they receive income, Y. Some of that has to be spent on required things like mortgages or car insurance or things like that, regardless of income. So even if my income is zero, I still have to do that spending. That's variable C0. And then any additional income I get or any income I get, I spend more at some rate less than 100% of that. That is to say, the variable C1 has a range of lower range of 0 and an upper range of 1. That is, it value of C1 is between 0 and 1. And then T was my tax obligation. So the story of consumption went like this, right? I spend money, and if I get some income, I spend some more money after I pay my taxes. Okay, so it's a very simple sort of story that we're hypothesizing. Of course, we would want to estimate the values of C0 and C1 using data, right? So what we have here is the basis for a couple things. We have the basis of a theoretical model. We also have the basis for empirical tests using data. So we would estimate C1, for example, by looking at the relationship between household consumption spending and household income, C and Y respectively. A well-designed experiment, of course, would have sufficient and adequate controls for various other factors that would impact that relationship, such that we were able to isolate the impact of those variables on each other. Okay, so enough about that. What I just said would hold true for all these equations. Okay, so investment, we're going to say that businesses invest some amount for reasons that we don't wish or don't know. That is to say, some exogenous reasons. We're going to call that amount B0. Again, something we would want to estimate. But then, of course, we're also going to say we're going to hypothesize that businesses will invest more when economic conditions look better. That is to say, when incomes are better, or Y. At what rate are they going to do that? Well, we're going to say that it's B1. We're not going to say exactly what it is, except for that it's positive. We hypothesize a positive correlation between household incomes and business investment spending. Then, of course, we're also going to hypothesize that the rate of interest, or the rate at which businesses can borrow, also impacts their investment decision, but in a negative manner. Okay, by now you're probably starting to get the flavor of how this modeling goes. Okay, government spending, we're going to say simply occurs, and then we're also going to say that imports and exports follow the patterns there below. That is to say that domestic consumers buy more imports when their incomes go up, or when the exchange rate is favorable to that, and we export more goods in a similar manner. That is, our exports go up when the economy in the rest of the world is doing better, or when the exchange rate is favorable to them. Okay, so that's our model, right? Hopefully nothing controversial. We have a number of parameters that we wish to investigate empirically if we were to employ this model, because as we're going to see, really the rubber hits the road on this in terms of the value of those estimated parameters. So you may hear you may turn on the news and they've got like 3 economists, right? And they all disagree, right? They think like, oh, if the government does this, then that happens. Or the other one's like, no, totally not, right? The other thing's going to happen. Or, the third economist will talk about the deficit or something, and they'll all have different. Okay, where do those different opinions come from? They're all using this basic structure. The differences come from what they believe the value of those parameters would be if you were to look at the data. Now you might say, well, couldn't they look at the historical data? Yeah, of course they could, right? But they're being asked to forecast things going forward. So to the degree which you can forecast the future from the past, well, not always the best, right? Okay, so that's where the differences come in. Okay, it's super important to understand that, because I think that people get the impression that they can sort of pick and choose. Like, well, I'm conservative, so that guy said a conservative thing, so he must be right. Or I'm a liberal, that one said a liberal thing, so they're right. Okay, well, no, the data doesn't care whether you're a Republican or a Democrat, liberal or conservative. It is what it is. All right. So here's a list of all of our variables. Again, if you're watching this and you don't have these slides, feel free to email me and I'll be happy to send them to you. There's also some associated spreadsheets with these videos too that I provide for my students, where they can actually work through these. So like the spreadsheets are interactive, right? You just change the variables and see how the models change. I'll be happy to send those too. Okay, so the one that's not visible here is autonomous exports. You could probably figure that out. Now, I'm not going to go through all these because it's quite lengthy, right? And you can do that. Suffice to say that some terminology here. You'll notice that the word autonomous shows up a lot. When economists say autonomous, what they mean is there are reasons that we do not wish to model, or that perhaps we aren't able to capture for some reason, but yet we want to acknowledge that they exist. Okay, so we put those in, right? So for example, households spend money even when their income is zero for reasons that really have nothing to do with the economy, right? It may be that they just have to pay their rent, right? So it's not necessarily nefarious, and in fact, it generally isn't. It's not that we're avoiding putting that in there. It's just, you're going to have to pay your rent no matter what the economy does. Okay. All right. Similar like autonomous business investment. Like certain payments need to be made for maintenance, right? Doesn't matter what the economy looks like. You've got to maintain your equipment. So even if times are very slack, your machinery still has a maintenance schedule. So autonomous investment spending. Okay, we go. The first thing we want to understand is this relationship of interest rates and incomes. That is to say, small lowercase I and y, right? And if we go back, and feel free to pause this video and go back and take a look, right, and see what that is, right? Okay, pause. Okay, welcome back. Of course, it's something like this, right? Is we have a negative relationship between interest rates and output. And if you're wondering, whoa, where was that? Okay, just look at our business investment function, right? We said that business investment declines as interest rates go up. And so therefore, the category of spending under I declines as interest rates go up. And therefore, since y is the sum of c and I and g, then as I goes up, we can say that all things being equal, y will go down. Okay, we call this relationship the IS function, or the investment savings function. It generally is seen as having a negative slope. It is a somewhat old-fashioned now way of modeling macroeconomics, but one that actually has worked reasonably good, right, to understand, say, what's happened in the last 10 years, which is a series of very unusual macroeconomic events. So despite being sort of old-fashioned and considerably simpler than the models that working macroeconomists use these days, it does a pretty good job. Okay, so I just asked what the slope of that function was, right? And then you go back and check. So go back and check. All right, good. Welcome back. If you guessed B2, you're right. Okay, good. You're starting to get how these models work. Okay, so here, B2, right? And that variable tells us how business investment responds to changes in interest rates, right? And that's not something, so here's where these economists are going to differ, right? If you're an economist who says like, whoa, interest rates go up a little bit, business investment's going to cut way back. Okay, well, guess what? Then the slope of that IS curve is pretty flat, right? And if you're an economist who says, oh, no, I don't think it really matters that much. Businesses mostly care about how good the economy is, not so much the interest rate. Well, then that IS curve is relatively steep. And as we'll see, that makes a huge difference, because if you think that curve is relative, if you think that relationship is relatively flat, then you know what? Then, tax policy by the government or spending policy by the government really doesn't do much to the economy. And if you think that relationship is very strong, well, then tax policy and government spending policy does a lot to the economy. In other words, what we call fiscal policy is effective, whereas in the former case, it's ineffective. See, it's not really about whether you like government or not. It's about how you think businesses are likely to respond to changes in interest rates that really matters. Okay, so let's continue. Okay, so as I said, IS stands for investments and savings. Okay, good. Why investment and savings? Because the particular market that we're allowing to fluctuate here is the loanable funds market, right? So it's household savings and business investment, right? So as you said a moment ago, really what this is all about is how businesses are responding to changes in the loanable funds market. Okay, great. Let's continue rolling on. Okay, let's flip over now to money markets, right? So up till now we've been talking about the goods markets, sort of the aggregate market for stuff in the economy. Now we're going to switch over to the financial side and talk about the market for money. Now, we did introduce this in another video. I'll dig that one up, and then I'll also put that in the description below. So if you want to link back to the details of the development of this money market, we'll check down there. Okay, great. Okay, so you'll recall from seeing that we assumed that the central bank fixed the money supply, and then we had this downward sloping money demand based upon the two ideas of transactions demands and speculative demand. Transactions demand is that first thing there, K times Y. Speculative demand is L times I. Short version, we said that money demand was a function of two things, whether, sort of how people's income, right, Y. Okay, so as people get richer, they hold more cash, we hypothesized. How much more cash? We don't know. K, again, it's a relationship we would have to estimate empirically. Okay, but they hold more, okay, that's our hypothesis. And then we also said that if the interest rates are higher, people hold less cash. Why? Because the opportunity cost of holding cash is going up. How much less cash? We don't know. Empirically, we'd have to estimate at L. And if you're getting the gist of this now, do K and L matter a lot? Yes, they matter a lot, because now those things are going to tell us whether monetary policy does anything or not. So like, if the central bank changes interest rates, does it do anything to the economy? Okay, well, matters on K and L, right? Matters on K and L. Okay, good. Let's keep rolling. Okay, we call this relationship, if we allow I and Y to vary, right, we call this relationship the L and LM relationship for liquidity and money. Again, this is the other half of the same old-fashioned macro model called an IS-LM model. Okay, we learned about IS just a moment ago. Here's the LM part, right? So why is there this positive relationship in financial markets between I and Y? Well, okay, as Y goes up, all things being equal, there's more demand for money, right? So go back to that last slide. As Y goes up, okay, that money demand function continues to shift off to the right. Okay, and then you can see what happens to interest rates, right? Okay, so we get a positive relationship between the two. How steep is that LM function? Again, as I said a moment ago, it depends. It depends upon those sensitivities. How are people's money demand and business, right? It's not just households. It's how is money demand in general responding to changes in interest rates. As interest rates are going up, are people, getting out of cash and starting to get into interest-bearing assets? Or are they sort of sitting on cash, right? So like right now, if the Fed raises interest rates a quarter point, do I adjust my portfolio away from non-interest bearing assets into interest bearing assets, or do I let it sit? Okay, well, that's how sensitive L is, how significant L is. As it turns out, if I sort of don't make any adjustments, then monetary policy doesn't do anything, right? If I do make significant adjustments, then monetary policy has real effect, right? So both fiscal policy and monetary policy are about how we respond to those actions, right? The initial actions themselves have impact, but it's mostly about how we, meaning you and me as households as well as businesses, respond to those adjustments. Okay? Again, doesn't matter. It's not about whether you like the Fed or dislike the Fed. It's not about whether you like or dislike the government. Okay, so let's talk about this quickly, right? So we said, by the way, the squirrels, right? So like these squirrels in these videos, right, a lot because when I do the 100 level classes, this is for a 300 level class, but when I do the 100 level classes, the first year college classes, I use a lot of squirrel examples, right? So if you go back and see the videos from that course, they're just loaded with squirrels, but it's sort of fun. Okay, so here's explanation of what I was just talking about with this LM relationship. I know this video is going to be kind of long, so I'm moving through it quickly so you can pause it and watch as you know, sort of take notes as you need to. Okay, combining those ideas, IS, goods market, LM, money markets, right? Then financial money markets, leave it there. Okay, we get a relationship that produces a stable rate of interest and a stable level of output. Okay, theoretically. So if we've estimated all those equations, right, then we can estimate this model and we can figure out the rate of interest that corresponds to a specific level of output. Now, why do we care about that? We care about that because if output is insufficient to maintain full employment and we want to crank up output to get more people back to work, right, then if we're adjusting interest rates through monetary policy, then we need to know about how far interest rates need to go to get Y to where we would, or household incomes to where we would like them to be. Okay. So again, as I mentioned at the beginning, there's a little spreadsheet that goes along with this. It's interactive, right? So that you can actually put numbers into it and see, like figure out how far do we have to adjust I to get to Y there. Okay, great. So if you have access to the course, you should pull that up now and take a look at it. Okay. So here I just go through some things to maybe run through that. Okay, so similarly, what if the interest rate changes, right? And if you don't have that spreadsheet and you just want to play around with it, go back to that model in the earlier slide, right, and just try changing I and then see what happens to all the equations all the way through and how that impacts that model output. In other words, how much do those changes, your forecasted changes in I, impact household incomes. Okay, so here's another one, taxes increase. Here's Jean-Luc talking about how it's so simple. I know it's this is a thing right now you're watching me go through. This is probably, it seems pretty straightforward, and it is a simple model, right? But I understand it's not that simple, right? Okay, so don't feel bad if you're struggling a little bit, but work at it, you can get it. And like I said, this is a real simple model. This is sort of 1950s style economics. So, when you're in chemistry, you learn about the Bohr model, the atom, which is sort of turn of the last century chemistry. Economics, when it's taught well, sort of follows a similar pattern, right? We start with older economics and we get more sophisticated as time goes on as in the educational process. So if you're wondering where you are right now, you're up to like 1950s style economics, maybe early 1960s style economics, which is pretty good. It's pretty good. So, all right. So now we start also thinking about exchange rates, right? So allow the exchange rate to adjust, right, in your little model, and kind of see what happens, right? And so when we do that, when we adjust the exchange rates, right, we can actually see now how if the Fed adjusts monetary policy, right? So change MS. So go ahead and change MS back in the equation. How would we expect that to impact exchange rates, right? And so the story sort of runs like this. The simple story is, right, if the Fed raises the money supply, then interest rates come down, incomes come up, right? So as interest rates come down, it repels capital, right? So investors don't invest as much in the United States in those sort of financial account style markets. And as a consequence, exchange rates come down, right? And as exchange rates come down, the dollar is losing value vis-a-vis other currencies. So exports start to pick up and imports start to fall off, right? So our category NX also starts to pick up, and we would expect there to be a boost in income associated with that. So, all right, so long story short, what our little model is showing us is that monetary policy impacts the economy through two potential channels. The first is domestic financial markets, right? So making it cheaper for businesses to borrow, but also in adjusting exchange rates downward, all things being equal, so that exports become more competitive in international markets. But of course, that has a short-run damage on households, right? In the fact that your imports are also likely to get more expensive. Okay, so it's a complicated story. Final thing to note, right, is you're going to find that if the foreign sector is quite large, that is to say, the NX, right, as a share of total household incomes, you're going to find that monetary and most particularly fiscal policy becomes significantly blunted, right? So a large nation like the United States is able to use those policies quite effectively to alter internal economic outcomes, but very small nations, really can't do those things. Just doesn't work. To simply explain that why is, if you work through the model, right, you'll see why it is. But the short story version of why that is, imagine you're living in a very small country and the government gives you a stimulus check. Well, everything you buy, or nearly everything you buy, is imported. So it doesn't create domestic incomes. That's your spending is going to end up creating foreign incomes. Okay, it's good to be a big nation, and it's very difficult to operate a successful macroeconomy by comparison in a small nation. Okay, all right. So Texas, if you're thinking about breaking away from the United States again, you might want to think again. There's a reason why large countries exist. Okay. In the next video, we'll be talking about even more sophisticated policies that countries use to stabilize domestic economies as it pertains to the foreign sector, specifically fixed exchange rate and capital controls. All right, this video has gone on far too long already, so we'll leave it there. See you next time. Take care, everybody. Bye.